All right, so in this video, I would like us to look at one simple concept, something that, let me see, let me just write it here. So we'll look at stop loss hunting. Stop loss hunting. So now under this, we'll just essentially look at why is it that when the market is, let's say, moving in an uptrend, you have a trending market like that. Okay, so once you have a trending market like this, you've put this as your key level. Remember, a key level is an area, it's not just a specific line. So you've put that as your key level. The moment the market comes back to this level, you take your trade and you put your stop loss just below this level. Let's say to put your stop loss just below that level. And then your take profit, one is at that high, then your take profit two is probably somewhere right around there. So then what happens? You notice that here you are stopped out before the market actually continued to go up. So this is what I mean when I talk about stop loss hunting. It's just basically being wicked out and then the market continues in your direction. So in this video, I want to look at how do you avoid such scenarios. So let's look at a practical example on the chart. So we'll look at a practical example. Let's say we are here. You've seen that the market here created some form of, it was previously a resistance level that has turned into support. So you see that this is a strong level. So after you see this here, since the market has been trending to the upside, what you decide to do is you take a trade from here because you've seen this bullish engulfing candle here. So what you do is you enter the market from that level, you put your stop loss just below this week. Then you're expecting it to go up. But what happens? You can see that even if you had moved this here, take profit is probably somewhere right around there, 1 to 2. You notice that here the market wicked you out. If you had put it very tight, it means at this level you could have been stopped out. If you had tried to extend it to this level, you would have still been taken out here before the market continued in your direction. Then let's see what happens. So the market actually continued all the way past that level. So now the main essence of this video is to simply avoid this happening to you. This. Or if you had moved, or if you are one of those conservative gurus, you'd have probably put your stop loss just there. And then you notice that you'll be wicked out here. So then to understand how you can avoid this, how best you can protect yourself is simply by, let me just go back to this part here. So let me go back a little bit. So then what makes the market move is, it's called liquidity. Liquidity. Now, liquidity just means where most retail traders have put their stop losses. So liquidity is basically the market going to areas on the charts where most traders have put their what? Their stop losses. And these traders are called retail traders. Now, retail traders just simply means people like us. People trade with very small capital. So people can trade $1,000, $10,000, 500, $150, 20, $100,000. All those are known as retail traders. $100,000, all those are retail traders. People actually move the market, trade big volumes. So they are like billions of dollars that can cause the market to move in a certain direction, but it's only for a short period of time. Now, for them to move this market in any direction, they'll need liquidity. So that's why you find that, like the example we did earlier, they'll go to areas where they know most retail traders have put their stop losses. And then they'll take everyone out. Once your stop losses are triggered, it means all that money now forms like a pool of liquidity that causes the market to move in the opposite direction. So now let's say, let me remove this. We're going to look at, I remove that. We're going to look at the same example, but then this time around, I want you to focus on what I would have done if I was the one to take this trade. Because I usually used to get stopped out a lot, but then I discovered that there was this liquidity which normally happens. So this is what I would do. I've seen that this market has been respecting this level. So there are two ways actually to go about it. The market has been respecting this level. The next most immediate level is this one to the downside. Seen this, right? So there are two ways I would go about it. So let me remove this for now. We're not going to use this one. Don't even mind. I'll come back to explain that. So I've seen that the market has respected this level. But since in the back of your mind, you know that there's going to be some liquidity grab, you put your stop loss, you put a line just above that level that you've drawn. Or if you want, you can put it attaching to that wick. Then what you want to do is wait for the market. You've seen like the way it broke out of this level. Wait for the market to do that. Once it does that and you get your candlestick confirmation, you enter. Now, when you enter from that level, notice the difference in terms of where you're going to put your stop loss. If you had put an impending order here, then you entered into the market, your stop loss will probably be somewhere around here. Then you put your take profit there. Now you notice that in this scenario, despite the market trying to come and hunt us for this, it failed because we waited for it to break past the lowest point that it had created. Because remember, in order for a market to create these liquidity grabs, what it will need to do is break the lowest point. So what you do is the point that you assume that you're going to enter from there, you are not going to enter the market. Instead, you put this line, you put a straight line like this one, this line here that I've put. Once you have that line set, you're going to put your stop loss a reasonable distance away from that line and then put an impending order here. Or if you don't want to do that, you can just wait for the market to get back to this level. And then once it does, enter, giving your trade some room by extending your stop loss a little bit like that. So this is one way of doing it. The other one is, it's also one of my favorites. So you look at, since if the market is in an uptrend, what it does is it makes these higher highs and lower highs like that. You can see that. Then what you want to do is you want to ensure that you pick the most recent higher low, which is this one. This is our most recent higher low. Then you enter the market immediately it touches that level. So this level, it touched it once, we're waiting for it to come back. Once it touched it, you enter the market from there. You put your stop loss just below this. And then you can put your take profit any level that you want to the upside. How does this protect you? Because you have two buffers, this one and this. Buffer, by buffers, I just mean levels that the market will find challenging to penetrate or to go below. So you have this as a buffer and this as a buffer. So the market possibly, even if it's doing a liquidity grab, it's not going to get way past the second barrier. The first one it will, but the second one it can't. But even if it did break the second one, it just means your trade is invalidated. In short, you're trading in the wrong direction as the market is moving. That's what I mean. So having two buffers like this is one of my favorites. Having two buffers like this assures me that if the market goes and breaks past this second buffer or support, it just simply means that my analysis of the market is wrong, maybe due to news or things of that nature. So these are the two ways. So let's go back to all of them quickly. Let me see if I can remove this. And by the way, try to pause this video and try to find support and resistance levels. Once you do, try to notice how many times the market does this. You find that it often does make these liquidity grabs. So you want to be very, very careful. All right. So the first one we did was, I said, just look at the lowest point the market has gone, put a line. If you want, you could even remove that so that you can see clearly. You put a line here, then you wait for the market to go and touch this line. Once it does, it has formed some kind of liquidity grab because a lot of retail traders will put their stop losses slightly below this. They just put it just below that. So then, in order for this market to manipulate the retail traders, what it will do is it will come straight down and tap into people who had put their stop losses here. Once those stop losses are triggered, it has some liquidity to move. But since the liquidity wasn't enough, it came back again to this level until it stopped out a lot of people. Then it continued to that direction. So my suggestion is you put that level there. You've put this level here. Once the market comes back, you wait for it to go and break that level. Once it does, like the way it did there, what you want to do is enter immediately. The market taps into that level. Why are we shorting? Yeah, we're supposed to be buying. So you enter immediately, the market taps to that level. Put this just below that previous low, this one. Then you put your take profit target somewhere around there. But your first TP should be here. A 1 to 2.6 risk to reward ratio. This is good enough. So you can either use this, or if you want, the second option would just be put a zone here. Once you've put that zone, this was like the most recent low. You enter immediately, the market touches this level. Or even just right there, you could have entered. Once the market touched that level, you enter, put your take profit somewhere right above that. Stop loss will just be right below this level. And then you have to wait now for the market to play out. So this will protect you. In most instances, you find that a lot of beginner traders don't know where to put their stop losses exact. And then they're always stopped out. And then the market moves in their direction. And that can be very irritating. So if you haven't noticed this before, try to open your charts, mark out your resistance and support levels. You will notice that there are certain instances where the market will be moving in your anticipated direction, but first it will weak you out, then continue that direction. To avoid that, put your stop loss in areas where it's difficult for the market to go back to. So this can be a previous support or resistance level. Like in this case, was a previous support. From the current support that you are at, this one, this is our current support. From that current support, you look for the next most recent support. Then put your stop loss just below that one. Once the market goes back to this, don't be scared and say, no, you think you are wrong, blah, blah, blah. Just wait for the market to play out. Whether it stops you out, ensure that you had already calculated your risk. I'll make another video talking about how to calculate your risk so that you know, because I feel a lot of people, what they do wrong is they enter the markets without a stop loss, and then they don't even calculate how much they will make or lose potentially in the market. So that's what even causes this thing. People talk about psychology and all that. It's just you don't know the amount you're going to lose. So once you enter a trade, let's say you had an account of $100, you find yourself losing 27, 30, or even blowing the account. That is going to pain you more because you didn't calculate your risk. And I've said all that just to say, put your stop losses in the best places where you can't easily be stopped out. And then you can see here, you had to wait for the market to deceive you, like it was going in the wrong direction, then it pushed back and went into our direction. All right, practice this. I'll see you in the next video. Don't forget to subscribe.